హాయ్ హలో వెల్కమ్ ఫ్రెండ్స్. ఈ వీడియోలో వచ్చేసి నేను కొన్ని టాపిక్స్ గురించి మనం డిస్కషన్ చేద్దాం. సో వాట్ ఆర్ ద టాపిక్స్ ఐఎమ్ గోయింగ్ టు డిస్కస్ నౌ? వన్ ఈజ్ ఫండ్ అడ్మినిస్ట్రేషన్ ఓవర్ వ్యూ, అండ్ అనదర్ వన్ ఈజ్ షార్ట్ సెల్లింగ్, and next side pockets and options, master feeder fund, debit and credit. In this concept I will discuss some topics. I will introduce these topics. Firstly, we will want to know about a fund administration. Fund administration means is the name given to the set of services provided in support of running of the fund. So it is one name, and it is provided some set of services which is to run the fund. There may be type of funds includes hedge funds, mutual funds, fund of funds, pension funds, unit trust, or other similar structures. These structures are often sometimes the fund manager will outsource to third-party companies who are specialized in providing these non-core services. These third-party companies are commonly known as fund administrators. The fund administration industry refers to group of companies providing these support services. There may be some outsources will be. I will discuss some outsource list of services. There may be which services are outsourcing. For calculation of NAV, it may be outsourcing. Preparation of semi-annual or annual accounts, and financial reporting, maintenance of funds, financial books and records, reconciliation of daily and monthly broker statements, payment of fund expenses, pricing the portfolio of the fund, calculation and payment of dividends and distributions, provisions of complaints and anti-money laundering, reporting and monitoring. These all services are outsourcing to that other persons. And typically this fund administration compromises two parts. Fund administration is one is relating to fund accounting and the activities registrar or transferor agent. One is fund accounting and another one is registrar or transferor agency, that is RTA activities. And while all the above and below services which are under the fund administration, it are same like an umbrella of some service provided will split out the RTA activities. So what the RTA will provide? Provision of shareholder services including process of subscription and redemption to the fund, and maintenance of funds shareholders register, and correspondence with investors such as monthly statement provisions and ad hoc notices, etc. Here we need to maintain the important in two core activities that the fund manager undertake that could not be outsourced to third-party fund administrator. One will be portfolio management and investment decision making. It will not be outsourced to third-party fund administrator, and sourcing investors for the fund. These two core activities which cannot allow to outsource to third-party administration. Any service that does not fall into above could potentially be outsourced to fund administrator or similar service providers, and this allows the fund manager to concentrate on the areas where they add value, that is investment decision making and growing the assets of the fund. So simply taking, what is the fund administration? Fund administration means it is set of services provided in support of collective investment schemes, that is fund, and its services are outsourced to specialists, that is third party companies that are fund administration. Fund means collective investment schemes fund, that is provide services, set of services, and whereas fund administrator means services outsourced to specialist, that specialist is known as fund administrator, and entities serviced including hedge funds, mutual funds, fund of funds, pension funds, or similar structures. And here funds are two types. One is fund manager and another one is fund administrator. Fund administrator means the third party company providing support services to funds. There may be example of Bank of America, Credit Suisse, Northern East, Brown Brothers, or JP Morgan Asset Management, HSBC, Fidelity, Morgan Stanley. These are companies will provide fund administration services. What services are provided? This provided services relating to calculation of NAV, preparation of semi-annual and annual accounts, and financial reporting and maintenance of funds, financial books and records, reconciliation of daily and monthly broker statement, and payment of fund expenses. And they also provide the services like pricing of portfolio of the fund, calculation on payment of dividends and distribution, provision of compliance and anti-money laundering reporting, monitoring and supervision of liquidation. And where does the fund administration fit? Means in fund administration we have three categories. One is front office and another is middle office and back office. Front office will have fund manager and investment decisions. In middle office we have brokers, trade settlement. In back office we have fund administration and NAV calculations. The second concept is short selling. The short selling is when an investor predicts that the price of an asset, that is such as stocks, commodities or currencies, is going to fall and agree to sell that asset in the relevant market at a certain prices. So without having actually purchased the asset. This is mean as short selling. Means once again the short selling means investor predict the price of an asset. Here assets means stocks, commodities, currencies. The asset price will be going fall and agree to sell that asset in the relevant market at a certain prices without having actually purchase the asset. In order to complete this transaction, the asset is borrowed from third party. So because he does not purchase the asset now, so he will borrow that asset from third party, normally brokers. The brokers will require the short seller to create margin account into which they must deposit some minimum portion of value of the trade, that is known as margin amount. Short selling means can be thought of the opposite of going long or buying shares. So when you buy shares, you are betting on the price of the shares going up. When you short sell, you are betting on the price going down. Means you are buying the shares means betting on the price of the shares will be going up. When you are short sell means betting on the price going down. Here three we need to remember. One is broker, one is investor, one is market. So broker lend shares and investor short sell in the market. Then this market buy the shares and give to the investor, and investor give the returns to broker. For example, I will give the one example. A fund manager is there, that person name is H, and he decided that shares of a Geo company are overpriced and predict they will fall. And in order to benefit for this fund manager decided to short sell 1000 Geo shares at their current price is $1000, and the total value of transaction how much will be 1000 into 1000, it will become 10 lakhs rupee dollar. And the trade details are now trade details as on date today date is 2027 will be the date, and settlement date will be it may be after 3 days, it may be taken 31st or 2030. And shall short 1000 Geo shares at a price at 1000 rupees per share, and then the total amount will be 10 lakhs. For the sake of simplicity, we will learn out without any money. A monthly later, the fund manager decided to close out of his position. This is done by buying Geo stocks on the market and returning it to the broker that it was borrowed from the short sell trade. This is known as buy to cover the trade. For example, here the shell short, the fund manager borrows some amount na, that 1000 Geo company shares from his broker and sell them on the market, and whereas buy to cover to close out this position, the fund manager now buys 1000 shares at the current market price and return them to the broker that the original short sale was placed with. Here if you look the possible outcomes, if the Jio share price is fall below or Jio share price is rise above the 1,000 rupees when the buy to cover trade is made, and whether it means the fund makes a realized gain or loss on the trade. For example, after 5th January, the price is going down or going up. So we will see the both scenario. On the date, the price of the Geo shares was decreased, means it was become 900 rupees. The fund manager closes out the position by pricing it to a buy to cover trade of 1,000 Geo shares. Then trade date it will become 5th January, and after 3 to 4 days it will settlement days. Buy to cover 1,000 Geo shares at a price of 900 rupees per share, and total amount will be 900 into 1,000, it will become 9 lakh rupees. Now what is the profit and loss outcome? The fund return the 1,000 shares to the lending broker, who must accept the return of the same number of shares was lent despite the fact that the market value of the shares has decreased. So here the fund realized the profit of 1 lakh, that is difference between the price at which it sold the shares it borrowed and the lower price at which it was able to purchase the shares it returned. Where if the price is went up to means not 1,000, it was became 1,100, then the price of the Geo shares was 1,100. The fund manager closes the position by placing a buy to cover trade of 1,000 Geo shares. Then trade date will be 5th January and settlement date will be 10th January, and buy to cover 1,000 Geo shares at the price of 1,100 per share. Then total amount will be 1,100 into 1,000, it will become 11 lakhs. The profit and loss will be the fund return the shares to lending broker, who accept the return of the same number of shares was lent. That time, however, the fund realizes a loss of 1 lakh, which is different between the price at which it sold the shares it borrowed from the broker and higher price at which it had to purchase the shares it returned. So, starting to make some sense, short selling can be confusing at first, but principles are fairly simple once explained properly. If you are further one, the what is the most famous short sale trade was happened in the world. So in 1992, George Soros, one of the founder of the first hedge fund, started sterling by risking $10 billion that the value of currency would fall, and Soros eventually made a reported $1 billion from the deal and was said to have broken the Bank of England. When, as a result of his trade, the bank was forced to devalue the currency and withdraw it from the European exchange rate mechanism. Why the fund managers will go for short sale? One is related to because speculation, the fund manager uses short selling to gain exposure to risk, and when fund manager short sells, he is betting on price falling and he is rewarding if this was happen. Speculating means differ from hedging because speculators deliberately assume the risk, whereas hedgers seeks to mitigate or reduce it. Hedging means, unlike George Soros, about the majority of investors use short position to hedge. This means they are protecting other long position with offsetting short positions. So overall, what is the short summary of short selling? Short selling means, here we have discussed that short selling means when an investor bet on price of an asset falling, the opposite of buying shares or going long. And in here, what are the transactions are involved? Investor short sells an asset. To do this, they borrow the asset from the broker, and to close the position, the investor buy the asset, that is buy to cover on the market at current price. Investors return the asset to the broker. Here we have three categories. One is broker, one is investor, one is market. Broker lends shares to investor. Investor short sells in the market and investor buy the shares and investor returns to the broker. In middle, he will earn the profit whatever. And how is the profit and loss is calculated? An investor short sell shares below our profit and loss outcome when position is closed. Here, price has risen, the trade makes loss. Price has fallen, the trade makes profit. And whereas, what are the reasons for short selling? There may be two reasons. One is speculation to gain the exposure to risk. One is hedging to reduce the risk on existing long position. And what is the risks is involved here means unlimited exposure while long position can only fall to zero. In theory, the price and asset can rise is to unlimited. And this is main concept to short selling, and we will discuss next concept relating to side packets. So what is this side packet? Side packet is a type of account used by hedge funds to separate illiquid assets from other more liquid assets in your portfolio. So in portfolio we have different type of assets. The from that different type of assets we will divide that illiquid assets from the liquid assets. Only investors at the time of creation of the side packet will be entitled to share the proceeds of the side packet when it eventually realized. So these illiquid assets, the side packet assets will be eventually whenever they realize it, then only they need to entitled to proceeds sharing, and future investors will not receive any share of side packet. Here, investors who receive a share of side packet at its creation and subsequently redeem from the fund will still remain a share of the side packet value when it get realized. So, as usually, only the most illiquid assets realize this type of treatment has only illiquid assets in a standard hedge fund portfolio can add great deal of complexity when investors liquidate their position. Here, what is meant by illiquid asset? Firstly, illiquid asset means when an asset is illiquid, it does not mean that the asset has no value. Here, illiquid asset means are difficult to sell because there may not be many buyers interested in purchasing the assets. So, common example of illiquid assets are including real estate, antiquities, and securities that currently have low trading volume, and such as those companies fund from companies delisted from the major stock exchanges. Investors often refer to stock with long trading volume as thinly traded stocks. So once created, a side packet can almost be thought of and treated as sub fund within the fund. So it will be treated as sub-fund. Typically, these side packet investments are hard to value and do not even have comparable security or assets, so that can be used to price them against. So, in this case, it is often left to fund manager to whom with an internally model to value the investment. So, has this raised significant conflict of interest issues? It is now common for the fund manager to waive any management or performance fee in these cases. So, how the shareholders will affect by creating these side packets means side packet in creating we have three shareholders will affect. One is existing shareholder, one is redeeming shareholder, one is new shareholders. How it will affect for existing shareholders? When the fund manager decided to create a side packet, existing shareholders are located shares in the new side packet account on pro-rata basis. These shares cannot be redeemed until either the fund manager realizes a portion or all the side packet investments realized. And redeeming shareholders, if shareholders decided to redeem or partially redeem is shareholding from the fund that holds an illiquid asset that may not receive their full entitlement if the valuation of asset or was underestimated. The advantages of using side packet is that proportion of the fund which is represented by the illiquid asset is only redeemed when it is capable of being accurately valuable. So this avoids prejudicing the redeeming shareholder and assures that NAV of the fund is accurate. And how it will affect to new shareholders. New shareholders will have no entitlement to share in the side packet holding the illiquid asset. This protects the new investors from any overestimate of the side packet valuation and allow them to enter the fund based on the fair value of the remainder of the fund's liquid portfolio. And creating the side pocketing, they have some issues also. What are the issues? One will be existing shareholders will receive a pro rata share on the new class of proportionate to their holding in the fund at the time of creation of the class. Whereas the documentation of the fund should be amended to cater for the creation of side packet. This will include making the necessary updates to prospectus. The creation of side packet represents a change in the terms upon which investor originally invested in the fund, and consequently the approval of the shareholder will require to create the side packet. So approval will be required, and second one, document need to be amendment, and existing shareholder will receive pro rata basis. And fourthly, the new class allowance will benefit from any interest, dividend or other income accruing to the side packet investment, and shares in the new side packet class can only be redeemed when the illiquid asset can be valued accurately. The new class of shares will be valued on each dealing day. Here, Securities Exchange Commission and side packet. Since 2010, Security Exchange Commission has launched numerous investigations into side packet accounts. So this investigation has been launched in response to investor complaints regarding their inability to redeem their side packet hedge funds share on the demand. So this Security Exchange Commission investigation, including the valuation method that fund managers use for side packet amount due to concern that managers may be overstating their value. Thus, the Security Exchange Commission (SEC) is looking into general lack of disclosure given to investors regarding asset allocation percentage and from the general portfolio into the side packet. With the liquidity suffered by the hedge funds in recent years, it is no longer unusual to see funds create side packet for the treatment of liquid assets. So this side packet can, however, create has many issues. Has they solved some? So we have discussed some issues. Now, for that issue, how can we solve? Some parties feel side packet are just another way of protecting manager fee by putting certain investment into magic box that is never to be seen again. And complex issue has arisen surrounding the crystallization of performance fee and adjustment of high water marks. So this just serves to highlight the potential conflict of interest that may emerge over time. It is essential that the framework for how and when side packets can be created be laid out in order to avoid conscious issues arising from the extent of managers' discretion to designate investment into side packet, and where creditors' agreement should be put in place where the side-pocketed investment has been leveraged. This is necessary to prevent creditors having recourse to the liquid element of the portfolio, and using side pocket have been viewed as adding a layer of secrecy and susceptible to abuse. Its side pocket investment are not included in the fee calculation. Executed properly, the side packets are usually a useful tool to help develop playing field of investors in a hedge fund, while which is experiencing liquid issues. Creating side packets is not a silver bullet for fund liquidity issues, and several operational and ethical issues must be considered before creating this side packet. Though the main concern should be the fair treatment of all investors will be required for this side packing. So overall, short falling. What is short selling means when an investor bet on the price, short selling is completed. After the topic is options. Options means an option is a contract giving the buyer the right but not obligation to buy or sell an underlying asset at a specific price on or before the certain date. It is options. Option means it is a contract giving the buyer the right but not obligation to buy or sell an underlying asset at a specific price on or before a certain date. Here, call option give the option to buy at certain price. So buyer is betting on the price going up. A means bullish market. Whereas put option means give the option to sell at a certain price. So the buyer is betting on the price going down means he is in bearish mode. Here, introduction options are types of financial derivative. So, in derivative, it is also one type. Option means a financial derivative is a security whose price is dependent upon or derived from one or more underlying assets. So, the derivative itself is merely a contract between two or more parties, and its value is determined by the price of underlying assets. So most options are created in a standard format and can be traded on public option exchanges. So you may come across some options that traded over the counter and also known as OTC. These option contracts will normally have non-standard element and are not traded on exchange. The price at which the underlying asset may be exercised is called strike price or exercise price. So the underlying price is exercising price is known as strike price or exercise price. The process of triggering an option and thereby trading the underlying asset at agreed price is known as exercising it. If the option is not exercised by expiration date, it becomes void and worthless. It in return for assessing the obligation, the writer of the option collects a payment, the premium from the buyer, and the writer of an option must make good on delivering or receiving the underlying asset or its cash equivalent if the option is exercised. Here, the contract details will include options or contract between two parties and the terms are detailed in an option term sheet. So options have multi elements and can range from standard to very complicated. So some items will be seen in the that contract whether the option holder has the right to buy or right to sell, and the strike price also known as the exercise price, which is the price at which the underlying transaction will be exercised on the quantity and the type of underlying assets, and the premium due to be paid by the holder to the writer of the option. Later, the settlement terms. Example, must the actual asset be delivered or will be settled in cash equivalent? What are the advantages for going for this option? Advantages are options trading is quite flexible and allow investors to assume or create a position they predict will be profitable. It can allow investors to profit from both rising and falling market. So disadvantages of the options. So what are the disadvantages will be there in the options? So disadvantages will be cost of trading option can be higher on the percentage basis than trading the underlying stocks. The short selling of option is accompanied by unlimited risk. Option can so complex that they require closer observation and maintenance will be required, and options will expire at fixed point in time and leads to most expiring worthless. There are different types of option will be there. So two types of option will be there. One is exchange traded option and another one is over the counter options, that is OTC. Here closer look into two types, that is exchange traded option type or type of exchange traded derivative, and they are also referred as listed options. Exchange traded options have standard contracts. Trading is settled Trading is settled through clearing house with trade fulfillment guaranteed by the Option Clearing Corporations (OCC). As each contract is standard, it is possible to obtain accurate valuation via pricing model. Some type of exchange traded options include index option, stock option, bond option, interest rate option, or options on future contracts. Whereas OTC counter option are not listed on exchange but traded between the two private persons, are sometimes referred as dealers options. The terms of for an OTC are unlimited and can be tailored around the investment need on the parties involved. On the most occasions, one of the parties is as usually a large institution like banks or brokerage houses. So option type commonly traded over the counter include option on swaps or swapations, currency cross options. Here option styles are the convention are used to help identify properties common to many different styles or options will be there in unique feature. There may be European option, American option, Burundian option, barrier option, exotic option, vanilla option. So this European option means can only be exercised on expiration. American option means may be exercised on any trading day on or before expiry. So if we see in money control also, we are in India, we are using the European option that can be exercised on expiration. Where if you go for the American option, any trading day you can exercise. And Bermudan option means may be exercised only on specified date on or before the expiration. Barrier option means the underlying security price must pass the certain level or barrier before it can be exercised. Exhaustive option, a broad category of options that may include complex financial structure and vanilla options. Any option that is not exhaustive. Here we see the trading overview. Options are typically traded in standard contract on several futures and option exchanges. If you go for the Chicago Board Option Exchange, the CBOI, for example, is an example of option exchange. Each standard option contract will have ticker symbol, and this allow for buying and selling of options on the exchanges and providing valuation and pricing details to vendors. Trading of over-the-counter option contract does not occur on the exchanges mentioned above. Typically, at least one counterparty in the OTC trade has well-capitalized institutions, for example, brokers, bankers, etc. OTC option allow investors to define specific terms which may not be obtainable on standard option contract. Another reason for choosing OTC contract is because they are not advertised to the market. There are very little regulatory requirements associated with them. Trading basics have two ways. You can trade options either in option holder or option writer. Option holder and option holder. Here option holder may go for long call or long put. So option holder means the investor who predict the stock price will increase may buy the right to purchase the stock, that is call option, rather than just purchase the stock itself, and there is no obligation to buy the stock, only the right do so until the expiration date. Here he will get only the right. If the stock price at expiration is above the exercise price by more than the premium paid, then the investor will realize the profit. If the stock price at expiration is lower than the exercise price, then the investor will let the call or contract expire worthless. The only loss on the trade will be amount paid for the premium. Whatever the amount of premium he has paid, he will lose to that extent only. But gain will be unlimited. An investor may buy the option instead of shares because they can gain a longer exposure without outlaying more cash. This is known as leverage. And whereas if you go for the long put, here an investor who predicts the stock price will decrease can buy the right to sell the stock at a fixed price. That is put option. He will go for the put option. Here he will be in a bearish trend, that is stock price will decrease. In call option bullish trend, he will predict the price is going up, and they will be under no obligation to sell the stock but have right to do until the expiration date. If the stock price at expiration is below, then the exercise price by more than the premium paid, then the investor will realize the profit. If stock price at expiration is above the exercise price, then will let the put option expire worthless and only last premium paid, whatever the premium he has paid. Next, we will come to the option writer side. Here, option writer will have short call and short put. An investor who believes that stock price will decrease can sell the stock short or instead sell or write a call option. So the investor selling a call has an obligation to sell the stock to the buy call buyer at the premium. If the stock price increases over the exercise price by more than the amount of the premium, the short will lose money because price can only decrease to zero but can increase to any price. The potential loss on short call will be is unlimited. And whereas short put, an investor who believes that the stock price will increase can buy the stock or instead sell or write a put option. So the investor selling a put as an obligation to buy the stock from the put buyer at the puts buyer option. And if the stock price at expiration is above the exercise price, the short position will make a profit in the amount of the premium. If the stock price at expiration is below the exercise price by more than the amount of the premium, the investor will lose the money with potential loss being up to the full value of the stock. So whatever we have studied in option means an option is a contract giving the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before the certain days. Here options are derivatives because they are derived their value from the underlying assets. Here we have two options, call option, put option. Call option means give the holder the right to buy an asset at a certain price within a specified period of time. A put option gives the holder the right to sell an asset at a certain price within a specific period of time. There are four types of participants in the option market: buyers of call, seller of calls, buyer of put, and seller of put. Most of the stock option contracts represent 100 shares of the underlying stock exchange. Investors use the option both speculate and hedge risk. Buyers are often referred to as holders and sellers are also referred as writers. So buyers means holders and sellers means writers. The price at which an underlying stock can be purchased or sold is called strike price, and the total cost of an option is called premium. Here we this is main the summary what we have discussed as of now in the call options. So after that, now we will see about master feeder fund. What is master feeder fund? A master feeder fund is a type of hedge fund structure. Investors place their money into feeder funds which then invest into a master fund. It is master fund that actually invest in the market. All the marketing trading occurs in the master fund level. So here investors place their money into feeder funds which then invest into master fund. This feeder fund feed that money to master fund. This master funds actually invest in the market. So all the market trading occurs at master fund level. The purpose of feeder fund is to funnily enough feed investors funds into the master fund and then receive the flow of profit and loss back, which in turn then feed to each investor at the feeder level. So whatever the money collected from the investor, that feeder fund will feed to master fund, and master fund will invest in something in some assets and it will get return. That returns will be given to feeders and this feeder fund will distribute to investors. It can, but it have master fund will be onshore LP feeder and offshore LTD feeders. So typically master fund structure is comprised of one master fund and two feeder funds. So feeder funds may be onshore fund or limited partnership organized in US Limited for US investor, or offshore corporation EL limited partner for non-US and US tax exempted investors. So onshore funds is related to US investors, offshore related to non-US persons and or tax exempted investors. So one master fund, two feeder funds will be there. Two feeder funds will be onshore funds and offshore corporations. Offshore funds means which is main city, and onshore funds means which is main city. Offshore funds means some rural cities and some tax exempted cities. Here, for understanding the master fund funds, one way to understand the master funds is method that works for a lot of things in life. So follow the money. An investor start at the feeder fund where they invest their money. This capital then flow from the feeder fund into the master fund. The master fund take this cash and invest into the profit, and profit loss generated in the master fund. This is called allocated back to two feeder funds. Finally, the feeder fund allocated the profit back down to investors. So here, master fund, onshore onshore limited partners fund or offshore limited funds. So onshore means US investors, offshore means non-US investors or tax exempted investors. At this stage, the capital was flowed full circle from the investor to feeder to master, back to feeder, and finally back to investors. Capital flows. As mentioned earlier, when understanding the master feeder fund, following the flow of money can help. Here we'll take a look at how the capital, that is investor money, moves around the structure from one entity to another. First of all, we need to start. Investing starts with investors subscribing their cash into feeder fund. The feeder fund then takes this capital along with any other subscription and invest them into master fund. And for their investment in the feeder, the investor will receive a shareholding in the case of offshore limited feeder, or percentage allocation in case of the onshore limited partner feeder. And it goes to note that at this point the feeder fund does not necessarily have to invest all capital received from the investor into master. So it can keep some capital back to pay expenses or even make direct feeder investments. In the majority of the cases through the feeder, you invest all its capital into master fund and then withdraw capital when necessary to pay the expenses. Is it normal doing? When the respective feeder invests to the master fund, it appears an investment from one of its investors. The master fund can then allocate the feeder as percentage of allocation of the master fund profit and loss based on their holding in their master fund. So profit and loss generation. Once the master fund has received in capital from the investor via the feeder funds, if invest this cash on the market, the portfolio is held at the master fund, and any trading expenses, interest, dividend, buy, sales, etc. are accounted for here. At the close of each reporting period, a valuation of the master fund is computed. Based on this valuation, the fund administrator will be able to calculate the amount of profit and loss generated by the master fund. At the feeder holding the master fund is known as profit and loss can be allocated back down to feeders based on the allocated ownership of the master fund. Now, how profit and loss will be generated at master flow back to feeder and then finally to investors. So firstly, master fund generate profit and loss on the market and it will send to feeder fund. Feeder fund manage and performance fee will be charged here and it will transfer to investors. So master fund generates the profit and loss and it will send to feeder, and feeder he will take some management fees and performance fees, and after that he will distribute it to investors. That profit and loss finally allocated to investors. So profit and loss now generated at the master fund has flowed down to the feeder. The next final step is to allocate to the investor. Each investor in the feeder will have either an amount of share in the case of offshore feeder or percentage of ownership in case of onshore feeder. These are used on the basis to calculate each investor pro rata entitlement of profit and loss from the feeder total and ultimately the master fund. Now, if we full cycle of investor capital through the master feeder fund structure and throw the profit and loss back to the investor, essentially when the feeder fund invest in the master fund is like buying shares in any other security. However, when a feeder fund invest in a security, it cannot peer into the underlying investment. It can for its investment in the master fund. This allows for the tax attributes, that is example dividend, income, etc. to flow from the master to the feeder. Why uses master feeder fund? A master feeder fund means structure is commonly used to manage funds raised from US taxable investors and non-US investors into one central vehicle. The master fund may be two reasons for using the master fund structure. One will be to save money by creating a bigger pooled fund. Operational costs are reduced as per investor basis, and in order to effectively manage both US taxable investors and non-US investors in a single structure, allowing the fund to cater for both set of investors. What are the advantages and disadvantages? Here, advantages will be multiple portfolio consolidated into one and reduce trading, transaction and operational cash, and combined assets can be used to obtain better financing deals, flexible legal structure or additional feeder or master funds can be added, and general partner performance fee will be able to maintain the underlying tax authorities on the onshore feeder, lessens administration burden of accounting for multiple portfolio, means administration will be cost will be decreased, reduce startup cost. So what are the advantages? One, consolidation will be done at one place and this trading operational cost will be reduced, and combining the assets it will better for financing, and flexible will be how for legal structure, and general partner performance will maintain underlying tax attribute, and administration cost will be decreased and startup cost also decreased. What are the disadvantages? Disadvantages will be tax accounting can become complicated, may not offer advantages to all investors at all times. Offshore funds subject to 30% withholding tax on US dividend. US dividend. Now we want to see the what is management fee, what is performance fee. Here the feeder fund is taking fund from the investor and giving to master fund. Master fund will realize the profit and it will share to feeder fund, and after feeder fund sharing that profit to investors, they will collect the management fee and performance fee. For management fee or payment made by the investor in the feeder fund to the fund manager, has compensation for managing the fund. So they are typically charged at the feeder fund level only. The rate charged by the investment manager to the investor is outlined in the partnership agreement. That is LP agreement will be existed what amount to be charged as management fee. Typically, the invest management managers will allow themselves the flexible to charge different rate to different investors or different class of investors or feeders. So in some cases, cash is withheld at the feeder level to pay the management fee. If there is no sufficient cash available to meet the payment, then the feeder may choose to redeem capital from the master to cover the cost. And performance fee, the same like as management fee, performance fee are charged at the feeder level only once the profit and loss generated at the master fund has been allocated to each feeder, and performance fee can be calculated and allocated at par partner. In the onshore feeder, this will take the form of reallocation of profits from the limited partners to the general partner, and in offshore feeder the performance fee is calculated by the series. So equalization can be used to ensure that performance fee have been allocated to each investor in the offshore fund fairly, because allocating performance fee based on the shares owned only does not include the carry forward losses or timing of subscription. In order for fund manager to receive their fees in the most tax beneficiary manner, the following is put in place. So one is offshore limited, another one is onshore limited, another one is offshore LP. So onshore limited feeders reallocate their fee from the limited partners, that is investors, to the general partner, the fund manager. And whereas offshore LP feeders are corporations and must charge their fees to the shareholders. And in the shareholders case, fund managers take their performance fee in the form of deferred compensation. So in recalculating the income in still acceptable way of compensating the manager in a tax efficient way. The shareholder feeder is set up to allow the reallocating of income back to manager. So this requires the following to be in place. The fund manager became a general partner of the master fund, and the master fund profit and loss flow to the feeder fund where the performance fee is calculated. When the fund is closed for the period, the fund manager takes its as fee. So this is the master fund, feeder fund, performance, master feeder, and another one is feeder fund. First topic we say that basic accounting, that is debit credit. Here for every action there is always an equal and opposite reaction will be required. So in accounting, double entry bookkeeping is a bread and butter work for fund administrator or anyone working in accounting. A solid understanding of debits and credits will help other aspects of accounting fall into place. So today's fund administration accounting softwares make it possible to stumble your way throughout without having a sound knowledge of manual WNT bookkeeping. So junior staff can often find themselves being shown how to book an entry and only full understand the why after they will manage the to piece together the bigger picture. So this learning in reverse process is not very efficient, and this is lesson. And along a practical example aims to give solid learning to anyone who wants to understand how to book journal entries. So there will be two entries. One will be debit entry and one will be credit entry. So debits and credits are systems used in bookkeeping to determine how to record any financial transactions. In accounting, debit means left side of the ledger account and credit means right side of the ledger account. So practically everyone has trouble with the rules of debits and credits. The rules aren't very intuitive, so don't be put off it. You do not get it as fast. The rest of this lesson should help you understand and provides also some memory tricks to help the recall the correct position. So to figure out whether the debit or credit on specific account, you need to modern accounting equation approach. So centrally we follow the equation is equal to assets is equal to liabilities, and here liabilities is equal to liabilities plus owner's equity, means asset is equal to liability plus owner's equity. Assets is equal to L plus OE, that is the symbol of love. You can assume that. So assets is equal to L plus OE, means assets is equal to liabilities plus owner's equity. When you are book a transaction to the journal entry, you must always maintain the balance above. For even every transaction booked, there are two entries made, double entry booking. There are five general categories that are all accounting can be grouped into. Depending on which category account you are posting to fall into, determine whether they need to debit or credit when booking the journal entries. There are five basic type of accounts will be there. One is assets, what we have discussed in a definition. Assets, liabilities. In liabilities, liabilities plus equity, owner's equity. In owner's equity, we have equity, revenue, and expenses. So total five basic type of accounts will be assets, liabilities, equity, revenue, expenses. Here assets will be example cash, holding, equipment, receivables. That is money owed to you. And liabilities means example expenses payable, tax dues payable, money owed by you and borrowed money. Equity means example common stock and retained earnings. Revenue means it is interest, dividend and incomes. And expenses means professional fee, commission fee and interest on borrowed money. So we will give some examples. When booking a legal fee, expenses, payment to uh, general, want to reduce cash and increase ledger fee expenses, so but are unsure which account to debit or credit. So we need that cash is an asset, so always remember cash is an asset. And legal fee is come into expenses. So we have assets, liabilities, equity, revenue, expenses. So whatever the transaction will become, the transaction will be going to this one only. One is asset, it may be asset, it may be liability, it may be equity, it may be revenue, it may be expenses. So we need to identify which type the transaction is. So what are the uh, what is there in the transaction that will come under into assets or liabilities, equity or revenue, expenses. We need to go that. So if you go for the assets, if asset is increasing, it will be debit. If the asset is decreasing, it will be credit. And if the liability is decreasing means debit and liability is increasing means credit. Equity is decreasing means debit and equity is increasing means credit. And revenue decreasing means debit, revenue increasing means credit. Expenses increasing means debit, expenses decreasing means credit. This is five types for assets, liabilities, equity, revenue. So for assets, increasing means debit, decreasing means credit. Liability decreasing means debit, increasing means credit. Equity decreasing means debit, increasing means credit. Revenue decreasing means debit, revenue decreasing credit, increasing means credit. Expenses increasing means debit, expenses decreasing means credit. So we will see some fund administration general entries. For example, bank fee expenses payment. So bank fee expenses. Here we have two. One is fee expense, bank fee expenses. Another one is cash. Bank fee expenses means expenses and cash means assets. So when we are paying, cash is going out means credit. Bank fee expense account debit to cash. And when the subscription is option, subscription means one will receive the money means cash asset is increasing, cash is increasing, as a cash account debit to contribution, that is equity. And when interest is received, that is cash account debit to interest received, interest receipt is a revenue, it will be taken in the revenue, it is cases. So this is debit and credit, this is basic accounting in the fund administration, and we will continue in the next video, next topic.